Okay, Brian Huddleston, welcome to Renovation Radio.
Thanks, Mark. Good to be here.
Awesome. How are things going for you today?
Really good, really good. Hey, we're coming off of a really great year for our part of the bank. So yeah, couldn't be better.
Good deal. Well, I appreciate you taking some time out to talk to us today at Renovation Radio. We got a lot of things to cover, and I know our listeners are going to love to hear the information that you've got on the expertise that you've built in your career on helping mortgage brokers and advising them on whether they should stay a mortgage broker or becoming a lender and a banker. So before we do that, I'd love to hear a little bit more about you, a little bit about your background, how you got into the housing finance industry, and tell us a little bit more about Fidelity Bank.
Yeah, no, hey, thanks for that. And yeah, so my background really, I think the bulk of my career was spent in investment management, buying every kind of asset-backed security that you could imagine, did as credit analyst, a trader, a portfolio manager, and then eventually that part of my career kind of ended because the company I was working for was relocating, and I thought, hey, maybe this is a good opportunity and a sign for me to move on and try something different. So because of my background in investing in securitizations, I think Fidelity Bank was attracted to that background. So, that's how I made my move to Fidelity Bank. Now, the bank itself, I've been here for about close to 7 years now, but the bank itself has actually been in the warehouse space since 1986 when they took on their first warehouse client. So they have a very long track record in history in warehouse lending, going again back to 86, and then even through the 2008 financial crisis. And their really their footprint at back then, the bank is actually headquartered in Edina, Minnesota, even though I'm sitting in Houston, Texas, and that's where the Houston office, we run the broker to banker emerging correspondent. The bank is in Minneapolis, and their footprint back then was the upper Midwest. And I think, with the purchase of what used to be called Warehouse Lending Group has now just been fully integrated and called Fidelity Bank. We've increased the footprint to a national footprint, but definitely a bank that you can go from broker to banker and then all the way up to a large correspondent. And we have the expertise to bank you at whatever part of your growth cycle you're in.
That's awesome. So what year did you move from the asset securitization side of the finance industry over to mortgage warehouse lending? What year was that?
Yeah, that was 2015. I made a real short stop with Bank of America in middle market lending for a brief time. It was about 18 months, sort of a boot camp on banking, if you will, before I moved to Fidelity Bank.
Very good. Very good. Well, before we dive in deeply here into your expertise, I think it might be important to lay out a few definitions and just make sure everybody understands, what we mean when we mean some of these terms. So the first thing I wanted to sort of talk about was, wholesale broker, which is where the investor is the lender essentially, versus a mortgage banker / lender. So in your mind, what's the difference between a broker and a lender, or a broker and a mortgage banker, wholesale versus correspondent?
Mm-hmm. Yeah, really the broker, someone who has a wholesale relationship with a lender, is someone who's bringing a borrower together with a lender and then taking a commission when the loan closes, versus a mortgage banker who's moved out of the seat of bringing two parties together and is actually lending off of their balance sheet, their own balance sheet. So they're actually lending, taking the risk of being the lender onto their own. And they're the ones who are at the closing table, closing the loan in their name, versus if you're a broker, you're closing closing in the name of the lender. So if they have a wholesale relationship with loanDepot, that note at the closing table will say loanDepot on it, versus being a mortgage banker or lender means that's got your company's name on it, the company you own. So that's in my mind the difference.
Very good. So one term that gets thrown out a lot of times, and I'm curious to see what you think about this. So the term table funding. So is how does table funding compare to broker versus mortgage banker?
It's very similar. The big difference, I think, in the broker world, when you say table funded, the lender really is their funding at the table with their capital, their balance sheet, versus the broker really doesn't. They're really out of the transaction at that point. But table funding as a lender, you're using your balance sheet to send your cash to the table. The warehouse bank is typically sending cash to the table to close that loan, which is really how a lot of, and I'm sure loanDepot is the same way, wanting to have the warehouse bank funding and then buying it off of the banker's warehouse line.
Sure. No, that's good. That's good. And then inside the world of mortgage banker / lender, there's different levels. I'm going to lay them out here, and there's different terms people use, but in my mind, you've got what's a mini correspondent, and I've got in my mind a definition of that, which I'll go over in a second. Then you've got what I call a non-delegated correspondent, and then a delegated correspondent. And so, to me, a mini correspondent is oftentimes what we're talking about here. A broker to banker, so a person or a company now who is now a mortgage broker, and they're deciding to learn more and try to become a lender. They might have their current wholesale partners partner with them in a mini correspondent fashion, which would be the closing disclosure and the closing documents be prepared by the investor, and versus what we would call a non-delegated correspondent, where the investor is basically just underwriting the loan from a credit standpoint. So the lender or the warehouse client in your case would be preparing the closing disclosure and the closing package, or having that done by a third party, and then they would utilize the investor's resources to underwrite and approve, final approve the loan, and then just buy it off the line, versus a fully delegated correspondent, which is maybe a little more sophisticated mortgage banker. They've got underwriting staff, W-2 employees, or maybe they use contract underwriting with one of the mortgage insurance companies or some combination of that. They may be transacting, they may be hedging at this point, transacting in the secondary mortgage market in a little more sophisticated fashion with mandatories and assignment of trades, and maybe even actually delivering directly to the agencies. So now I know those terms, mini correspondent, non-delegated correspondent get thrown around. Is that how kind of you see it, or do you see it a different way?
Yeah, but you laid it out pretty well. I think mini correspondent, non-delegated correspondent, those actually could be synonymous. Just because you'll hear those two terms. The other term you'll hear also with mini correspondent, non-delegated is going to be emerging banker. You hear emerging banker, and that really
that's right. Emerging banker. I've heard that too. Yep.
Yeah. And you'll hear people say that someone's an emerging banker when they're moving from broker to banker. We say they're emerging. They're not kind of like that was a term that was used back in the late 90s, early 2000s about emerging countries, the BRIC countries. They're coming into being first world from third world, or if you look at it that way.
Ooh, I like that. I like that analogy.
Yeah. So yeah, just the same way, being a broker, you're emerging into being, a banker, mini correspondent, non-delegated correspondent. And then, you mentioned delegated. I mean, definitely the same thing. Those are higher net worth bankers who have decided, hey, there's a yield pickup to moving to delegated that I think I want to take advantage of. I have a high enough volume to make that make sense. But we've worked with some clients who have the net worth and the ability to move to delegated, who've told us, hey, we just don't want to do it. We just don't want the risk. That our volume still isn't high enough to make us comfortable with, bringing on and paying that underwriter salary. So I'm just not ready to do that. So, all the guys that kind of fit that broker to banker, many correspondent, emerging banker, they could be anywhere along the spectrum, and you just never know where someone's going to land. It really depends on their risk appetite and how much they want to take on, and what their budget is.
And then actually using your analogy from the emerging country, going from the third world to the first world sort of thing. If the emerging banker tries to do it too quickly or doesn't work with a trusted advisor or consultant in the process, a lot of times, and you and I both probably have seen it, they go back to the third world pretty quickly, because they don't do it right.
That's right. That's right. So yeah, very important to get with the right people, and understand. That's the thing is I think in a lot of these cases, if you don't understand the risk going into it, and maybe you've been led to believe that there's no risk or that it's very low risk, and then you end up getting bitten by something that happened there where you learned, hey, if I had appreciated the risk more, maybe I wouldn't have done it that way, or maybe I would have gone in with a little more information and understood a little better. Those are the people, like you said, they usually get bitten and start moving backwards. And it's good to flesh all those risks out early and try to get those people to get some, help get their hands on some knowledge to really educate themselves before they make the move.
Yeah, it's a cliche, but kind of go slow to go fast, right?
Right. That's right.
So another terms that get thrown around kind of synonymously sometimes, but they're different, is lender versus investor. So what do you think about those two terms?
Yeah, I think brokers, especially someone who's been a broker for a really long time, they will be using a warehouse line as a correspondent lender. They'll be making loans off their own balance sheet, and then they'll refer, like for instance, they'll refer to loanDepot as their lender. And I usually don't, if I can, I won't correct anybody. We'll come back and use the word investor. And if anyone ever says anything to me, I usually just say, well, that they're sitting in the investor seat now. You're the lender. Because that really is what happens. If you move from broker to banker, loanDepot is your investor now. They're going to be buying loans off your warehouse line, and then the warehouse bank will be settling, and that's when you get paid, when the loan sells. So no longer are you collecting a commission check after the loan closes. You're waiting for the loan to sell, and you're responsible for getting that loan off of your warehouse line and sold to loanDepot.
Sure. And then one more term, in terms of the thing that you provide at Fidelity Bank for your clients, is what's called a warehouse line of credit, or maybe slang term warehouse line or warehouse.
Mm-hmm. Mm-hmm.
So what's your best definition of a warehouse line of credit?
Yeah, really, it's just a line of credit that you are using to originate mortgage loans. Really, I mean, it's the same, everywhere. You're getting a line of credit, not really like a credit card, but similar to a credit card, in that you're told what your limit is. You will spend up to your limit basically, and the way to keep that limit open for yourself is to be working with the investor to clear the conditions on the back end to get the loan sold. And the faster you can get the loan sold, the quicker you're going to get paid. So, a warehouse line is really just that. It's a line of credit that you're using as your working capital. That's how you are, the way we look at mortgage companies at Fidelity Bank is that they're a manufacturing company, but they're manufacturing credit products, which are mortgages. And they're maintaining an inventory of mortgages on their balance sheet that is created by this warehouse line. So it's creating the asset, that's going to be what sits on, and the mortgage itself is going to sit on the asset side of the balance sheet. And then the line of credit is obviously the liability side of the balance sheet. And the difference between those two, the value of the asset, the value of the liability, is basically what you eventually will make on the sale of that inventory of loans that's sitting on your balance sheet.
Sure. So it's interesting. So when the lender decides to make a loan, whether they use a warehouse line of credit or some other means, their collateral is the real estate. So the consumer, the borrower, the buyer, depending on the transaction type, signs a promissory note at the closing table that makes them indebted to the lender. And then they also sign a mortgage deed of trust, depending on the state requirements or state law, that ties their indebtedness or their debt, their promise to repay the debt to the real estate, minus their down payment or whatever. And then your warehouse line of credit, and it may not be a permanent thing, but but while the loan is in the lender, I'll call it the lender stage, not in the final resting place. Mm-hmm. Your collateral is that promissory note. Is that correct?
That is correct. Yep, we will. We take a security interest, as we call it, which is perfecting your security interest is basically saying, hey, this is our collateral, that mortgage note for every advance to the closing table that we make, our collateral, how we would get repaid if, let's say the worst should come to pass, the company goes bankrupt in the middle of, having, call it, $4 or $5 million in mortgages sitting on their warehouse line. Well, we would have to work with, maybe a bankruptcy trustee, or we would work with whomever we need to get those loans sold to get us repaid. And then, whatever claims the company also has to their own income, they might have other creditors that are sitting there, waiting for them to get their income to get repaid for whatever other debts they may have. So yeah, definitely those notes are the bank's collateral on the warehouse line.
So just a bit of an aside, help me with sort of the travel, if you will, or the path of that collateral. So
right.
We're at the closing table, and the consumer, let's just call it the borrower, signs the promissory note and a whole bunch of other documents. And then what happens to that note typically for your clients that have a warehouse line of credit from you, from the settlement agent, if it's a title company or an attorney state, depending on the state, but regardless, so now the settlement agent, that they've made a copy of the promissory note, they've gotten a copy of the actual your collateral. To everybody that needs a copy, they've got the original with the borrower's ink, mm-hmm. maybe e-signed in some cases, but mostly ink. And is that blue or black ink?
Typically blue.
That was just a little pop quiz there. So blue ink signed note, promissory note. So what happens next? So what does that settlement agent do with that blue ink signed note?
Right. So really, what will happen is there will be delivery instructions for the collateral that are in the closing package that the settlement agents should see. And what that will tell them is where to ship it to, and where to ship it to would be to Fidelity Bank in Houston, Texas. And so we receive the note, and as soon as we receive it, since we were the ones who funded it, we know where it's going. So, if it gets shipped to us from, let's say, a borrower or settlement agent in Georgia, it gets shipped to us from, say, Atlanta to Houston, and right away we're going to ship it right back where it came from. The settlement agent may be in Atlanta, but I think I'm not sure is it Atlanta where loanDepot receives collateral? I'm not sure.
That's a good question. I really don't know.
Yeah, maybe something we might want to know, but right. Our staff. But we will ship it to where loanDepot is processing the notes, and it will be shipped under what's called bailment or under a bailee letter, and the bailee letter will basically say, hey, loanDepot, we are shipping this note to you with the intent of you purchasing it. Please treat it as if you own it. And if you decide not to own it, then please ship it right back to us. But if you do decide to own it, there are some wire instructions underneath it. Please follow the wire instructions to remit proceeds to Fidelity Bank for final settlement. And once loanDepot settles the loan, which is sent, they purchase the loan, we settle it. loanDepot purchases it, sends us the proceeds for purchase. We then settle the loan, meaning we pay off what was borrowed to originate. And then any excess proceeds, and there should hopefully be excess proceeds after a loan settles, goes into the account of that particular client, and that's how they're getting paid for the sale of the mortgage, and that's the end of that deal. So and that time between shipping, I guess, closing and purchase, right now what we're seeing is around 10 or 11 days from closing to eventual purchase and settlement.
Yep, that's similar on our end. I think the average is right somewhere in there somewhere between 9 and 11 days.
Yeah,
has kind of been the average. So for most people, for most loans that are transacted efficiently. So that's a lot to think about. So I'd like to maybe just dig into some of the things if part of our audience is perhaps a mortgage broker who's thought about or thinking about becoming a lender, becoming a mortgage banker. What are the sort of things that they would need to sort of think about in their mind, and paperwork and other things they have to do to get ready to become a lender. So the first thing that comes to my mind is the licensing. So I believe most states, if not every state, has different licensing requirements for a lender versus a broker. Like I know, for instance, New York, it's very difficult to become a lender in New York. So I even worked for a large top 10 independent mortgage banker in a past life, and we could not get licensed in New York. It was the craziest thing. It was almost to the point where we were going to buy a mortgage company in New York just for the license, because it was just so difficult. And then some states it's very easy, and everything in between. So what sort of hurdles have you seen from mortgage brokers, in terms of the licensing requirements? Like how does it work in Texas, for instance?
Yeah, Texas is, well, I think this has since been dropped, but there was a time when you had to have a brick and mortar in Texas to get a license. I think I want to say that went away last year. I might check on that, but
now that's a good term you used there. So brick and mortar. So that means you have to have an actual physical office in the state in order to become a lender. Is that what you mean by that?
That's correct. Yeah, you have to have a physical office. Now, I had seen some clients. I mean, we will have clients, say, for instance, in Orange County, California, seems to be popular. That's sort of the epicenter for that. There's a huge bulk of lenders in that area and brokers in that area, and we will see these brokers or lenders will get a license in Texas, but they will typically have the brick and mortar that they will use is the loan officer's actual home, which makes sense because, in a lot of cases, a lot of loan officers work from their homes. So that I think that's what a lot of folks did to get licensed. But, I think for every state, there's some little wrinkle. I think, for instance, I don't know if this is still true or not. I think it is, but Florida requires audited financial statements. That's not every single, state that requires that. But there, you definitely have to find out from your state licensing board what your state requires and who you have to deal with. That's the tough part about getting started. But usually it should be the same people that you got licensed with become a broker, so you'll have to go back and talk to convert that to a banker's license, and you really will probably have both of those licenses working in tandem, because when you're a mini correspondent, emerging banker, non-delegated correspondent, and you do FHA, well, you're not going to have the net worth yet. And this is probably beyond the scope of what we're going to talk about, but just to mention that you'll probably have a hybrid where you're brokering your FHA, but you are banking, say, the conventionals, the VAs, jumbos. Maybe you do USDA. Those can be banked, but FHA is a little different, where you're going to have you're going to be brokering those until your net worth qualifies for at least mini Eagle. And then that also requires audited financials, but that's again, a little beyond what we're going to talk about today.
No, that's a great point, because I know Florida, you're right about Florida. Florida is audited financials to be a lender, whereas like in Georgia just one state up. It is just essentially just it's the same process, just a bigger, bond.
Yeah.
In Georgia, and I think it's pretty typical. They require a little bit more of a bond. I don't know that any states have a higher net worth requirement. Maybe some do, but again, it's state by state. And but I have noticed a lot of folks that are lenders in, so let's say Georgia and Texas, they are brokers in Florida because of the audited financial requirement, and that which is very daunting and extensive and expensive. And then for the FHA, it's a great point because not only do you have to have audited financials, it's got to be a HUD approved auditor, which is a special audit,
Right.
A very special audit and a very expensive audit that may not necessarily be a GAAP compliant audit. So it counts as audited financials, but not in the traditional sense. It's like, I'll quote it, air quotes, special audit just for HUD. So we love that. And those auditors charge a special fee for those special audits as well. Right. And then so all that on top of keeping a bunch of money in your company as well to get the Eagle. So a lot to think about there. And that's very common for us in our correspondent channel, which we offer mini or emerging banker mini core and non-delegated core. It's for both. It's very common for the folks to broker their FHA loans, and then they're the lender on the rest of their loans. So that's
correct.
So don't think there's too much here, but just maybe touch quickly on compliance. I don't know that there's any additional QC or auditing requirements, for compliance. Obviously, there's, as the lender, there may be some more risks to think about because they're the one any let's say RESPA or TILA or any other sort of regulatory compliance stuff does can fall back harder on the lender because you're not relying. You're the lender, and your investor may or may not necessarily test all of your loans for every bit of the compliance. So I think there's a little bit more compliance wise to think about it. I know a lot of folks outsource a lot of that compliance risk.
That's right. I'm glad you mentioned that. That's exactly what I was going to say. I think, when you're making the transition from broker to banker, I think the quickest and easiest answer to that would be to contract with a doc prep fulfillment firm, a law firm that provides that service, who has in-house compliance attorneys who can help you. That kind of goes also back to licensing. The states, I know Texas does ask questions about different compliance programs, how you're tracking compliance with at least state licensing requirements. And I know you could go to your law firms that handle your doc prep and fulfillment, and all of them really could handle those questions. But if you're in a state where let's say you've done it for a while, you've been in non-del or mini core for a while, and you want to move on to not having to use a doc prep fulfillment service, well then maybe you contract with one of the other firms. There's several really, really good firms that do that specific service for non-del or companies that don't have in-house counsel to handle this for them. And there's a lot of them. And I mean, there's probably not as many who have in-house counsel to handle this stuff for them, but there's that's why there is such a big industry, legal industry around real estate, because there is a need. So yeah, there's a lot of resources out there for that.
For sure. So let's jump into what are the basic requirements to become a lender? So we've talked about audited financials, but is there like a hard, and again, you could talk industry generally, or you can talk the requirements there at Fidelity Bank.
Yeah.
But is there like a hard line, like let's say net worth requirement? Is there a rule of thumb, or do you guys have hard rules for the net worth?
The net worth, really our warehouse line sizes start at 2 million. So, we're really looking for someone who, has between 200 and 250,000 in cash. Really, that's the net worth of most of these broker firms. I mean, it's not like having a true man. I mentioned, mortgage companies, we liken mortgage companies to manufacturing firms. Well, it's not truly like a manufacturing firm because you're not sitting on much machinery or lots of raw inventory or things like that. Your balance sheet basically is cash. And if you're already a mini correspondent, non-Dell correspondent, you have you probably have a little bit of equipment. You have a warehouse line. That's your big liability. Your big asset piece is going to be the loans themselves. But if you're just starting out and you don't have any of that yet, then you really just have cash. So we're looking for around 200 to 250,000 in cash to start, and then we like to try to target a debt to equity ratio of 10 to 15 times debt to equity. And I know that in some instances, maybe more instances than not, 10 to 15 times may be a little restrictive. We could go up to 20 times in certain instances, so long as we have a commitment to try to build capital to get yourself down to a level of debt to equity. So you basically take your equity, which is your cash, really, and you multiply that by between 10 and 15 times, and that will come up with the size of a commitment that we would write to.
So with a $2 million warehouse line, without putting too much stress on the situation, in a given month, how many dollars of mortgages would a typical merging banker be able to fund on a $2 million warehouse line? What do you guys see with your clients currently?
Yeah, I mean, I think that you could count on being able to do, 4 or 5 million a month, because you're going to turn it, 2 to 2.5 times a month. And then the reason I'm not saying, if you're turning it 3 times a month, 3 times 2 is 6. And I'm not, sometimes you're going to have a little bit of lag. You want to allow for a little bit of cushion. You might have a loan that hangs around longer than you want to for a whole host of reasons. You never know what's going to cause that, but you want to have a little cushion. So I usually say, if you have a $2 million line, you could usually fund between 4 and 5 million a month.
So somebody who's originating roughly $50 million a year in mortgages, give or take, would a $2 million line that would keep them, and depending on the loan sizes and the
Yep.
timing and all that stuff too, that would be about what we're talking about.
That's right. Yep, that's right. Yeah.
Now, as far as experience, is the same question? Is there a hard and fast, like you've got to have X number of months or years experience as in the industry, or really good references, or hey, we know who you are, or what? How do you guys look at the owner or the owner's experience?
Yeah, I mean, definitely the longer experience you have in the industry, the better. I mean, the typical profile that we're seeing when we see someone who's doing this is they've usually somehow or other found their way to mortgage, like all of us. And it was probably early in their career, they started working for somebody, whether that be, hey, I started working for loanDepot, or I started working for my neighbor who hired me as a kid making coffee for him, and then I became a loan officer. So they probably worked for a company like that for a while, and then they maybe they moved up, and eventually we're seeing lots of people who were like branch managers for a large mortgage company, who worked in the net branch system, and they're looking at it and seeing hey, I've done this for so long and made a lot of money for the owners of this company, but I think I could probably make more money if I do this on my own. That's what I'm thinking. I want to do that. And that's when we'll get a phone call from somebody saying, hey, I got your name from Mark Hammond over at loanDepot, and he said to give you a call. You guys could handle broker to bankers. So when they get to that stage, typically what we see is someone who, and what we look for is someone who's at least has 6 to 12 months of experience as a broker, owning their own company. And then we'll definitely ask for references, but we will also ask for their scorecard, broker scorecards, or if they do have a line of credit and they're already doing they're already lending, we'll ask for their investor scorecard. And typically what that will show us is just the type of product they're doing, what the borrower FICOs have been, what the file deficiencies have been, performance metrics for the underlying, for the collateral that they're delivering in to to the investor or the broker. So that'll give us an idea of what kinds of loans are originating, whether or not they're stretching on credit to get deals done or not. And honestly, we don't really see a lot of people who really are stretching. I think a lot of people have a lot of respect for credit and the risk they're taking, especially after what happened in 2008. I think a lot of people, a lot of the younger people, I think, you would think people who haven't been through it, may not understand the risk they're taking. They might want to stretch, but I think that the older folks like us, Mark, are that scar is still there, and I think a lot of us still remember it very keenly and talk about it. So you don't really see a lot of people, stretching, and so that we will look at that, and we will look at their experience. How long have they been doing it? I mean, the longer, obviously, the longer the better. But doing it as a company, 6 to 12 months, like I said, typically is what we want to see.
Yeah, you're absolutely right about those of us that have been around for a while and the scars. I can it's almost like I can recall sharing a cab one time at a trade show with 2 or 3 other mortgage bankers. We were all headed to the same hotel, and I forget the exact year, but we're all sitting there, and you start hearing the sob stories about '08 and all that, and you think your story's bad. And I never got a chance to share my story because I felt pretty bad about mine, and theirs were way worse than mine was. So everybody's got the sob story, the scars, the whatever you want to call it from that time. That was definitely a crazy time, and hopefully we've all learned something from all that pain for sure.
Yep, for sure.
So one thing, so it sounds like it feels like you want to see a progression. Someone has been a successful mortgage banker, perhaps a successful loan officer working for somebody else, and then they've decided to open up their own company, as you said, which I think is a great point. They've shown they can run a company as a mortgage broker for a period of time, because that's a different level. If you're a W-2 employee of somebody else as a loan officer, a branch manager, or maybe something else, and now you've taken the step to become a business owner, and you've managed a successful business as let's say a mortgage brokerage. Now you want to go to the next level, which would be to get a warehouse line with a company like yours, with like Fidelity. So yeah, I think it's important to see sort of that progression and wanting to take it, to the next step and gain, take on a little more risk, but also with that risk comes some benefits as well to get a little bit more control of the transaction, which we'll talk about here in a second. But one thing I know that you stress is important is the use of, and I'll use this industry term sort of loosely, but a fulfillment company. Could you just take a few seconds and just talk about what a fulfillment company is and what they do and what that role is?
Mm-hmm. Sure. So really what they're doing, and I will just say I'm not an expert on everything that happens internally, but what we see them doing and how they help the warehouse bank is that they're going to, most of them are going to take your LE and as many docs as you've produced at a certain point, and they're going to produce the CD for you. They're going to make sure, of course, that it's TRID compliant, and that the note that they produce for you is going to be compliant and all of that, all the good stuff you want them to be doing. But they're gonna prepare that package to such a degree that once it gets to the closing table, that they're going to have handled most of what needs to be done to get to the closing table, along with the processor in that company, whether that be a processor who is working for the company as an employee or as an outsourced processor. But they're working with the processor in the company to get that loan to the closing table. And that's the doc prep part that they're really focused on. And then once you get on the other side of the loan closes, the loan needs to sell. They're the ones who are going to be helping the processor or whomever is within the lender's company themselves to bird dog the back end information that needs to be done. The fulfillment, the part is fulfilling those requests from the investor that the investor's looking for to purchase the loan on the back end.
Yeah, and I think that's important, especially early on. And in my career, I've helped folks move from broker to banker as well. And that's what I always say. I'm like, even if eventually you're going to either hire or do those tasks in-house, at least for the first half year, 6 months, whatever, let's hire a fulfillment company and just watch how they do it, and find out what you like about what they do it, and what you may not like how they do it. And that way you'll definitely learn on their, and pay a cost pay a fee for their expertise versus learning the hard way, going from first world to third world back to first world, like we talked about earlier. So much cheaper to learn by just writing the check to the fulfillment company and just see how things are done the correct way. And then you can decide later what parts of their process you'll implement, what parts maybe you can do better or alter or whatever. And then I always say do one. Let's do one all the way through. Like the people that I've seen, they get in trouble is they sign the docs for their warehouse line, and then they move their whole pipeline over there. And most times it works out fine, but I've seen a few where it hasn't, and that's typically the case. They move too fast. So I always say, hey, let's do one. Get your warehouse get your warehouse line in place, all the docs signed, and try one loan all the way through. From take the application, disclosures, investor approval, CD, closing package, and it's bought off the line, and then regroup, and then find out, hey, what went well, what didn't go so well, and then adjust as needed, and then try another one. And then maybe you can move a few loans over there from broker to lender, but don't do it all right away. Let's get one all the way across the finish line, bought off the line, and then sort of have like a recap call or meeting or whatever, and find out what you liked, what you didn't like. So
that's right. I think you bring up a good point too about the cost of it. The cost of making a mistake on a loan that can't be purchased, will make the fee that you're paying to the doc prep fulfillment company seem almost a no-brainer. Hey, let's just pay the money, so that way we're not ending up having a loan we can't sell, and then maybe having to take it to scratch and dent, or have it hanging around the warehouse line too long and costing too much. I mean, that's something I really try to stress to folks who are wanting to make this transition, that the cost of it may sound like you're paying a lot of money. I think you're probably paying like $500 a loan for it to go through the from end to end in a doc prep and fulfillment company. But the cost could be a lot higher when you start talking about bids and scratch and dent.
Sure. Well, let's so we've talked about a lot of the risks involved in becoming a lender. Let's talk about a couple of the benefits. Now, I'll just sort of take one sort of off the table. Pricing. The pricing you get from your investors could be better. I always say, if you can negotiate a better price with your investors, being as a correspondent versus a broker, then more power to you. But that wouldn't be the main reason that I would do it. You may get a better price, you may not. That's out of your control.
That's right.
But a couple things that are in your control and ought to be the most important reasons for becoming a mortgage lender, mortgage banker versus a mortgage broker is first, control of the appraisal. So as a broker, the way the law reads currently and has for a while, a mortgage broker cannot be really involved at all in the appraisal ordering. Their investor or their lender, as a broker, has to be the one that fulfills and orders and places and takes care of the appraisal ordering. But I believe as a mortgage lender, mortgage banker, you have a little bit more control over the appraisal ordering process.
That's right. That's exactly right. And that is a big advantage, is being able to control and order that appraisal yourself, have control of who you're dealing with. You can move around to and work with different appraisal management companies. But of course, the nice thing about the appraisal management company is they will also keep you compliant, because you really don't have a lot of contact with the appraiser for obvious reasons. You never wanted to make it look like there's any kind of influence you've had over how that home is getting valued in terms of what is being lent. So, but yeah, that you're right. That is a big advantage to moving from broker to banker.
Yeah, so it's getting control of that appraisal order. So we, as part of our correspondent approval process, we want to see that the correspondent or the lender, mortgage banker, all those terms I'm using synonymously, we want to see that they have their own written appraiser independence policy. So that's part of the requirements to become an approved loanDepot correspondent, is you've got to have an appraiser independence policy, regardless of how you order the appraisal, whether you use an AMC or whether you do it following your own policy. But if you want to order it yourself and follow your policy, that's fine. We'll let you do that. Or if you want to use an AMC, that's fine too. We still want you to have a policy in place because we think it's important that you understand, what you're getting into, because you're the lender. It's not us anymore. And whether it's the AMC or you, it doesn't matter. It's got to be compliant. And then we've also found that it's interesting. We're a large, top 5-ish national lender, and we're signed up with a lot of AMCs. We do a lot of business with a lot of AMCs, appraisal management companies all across the country. But we found that our clients a lot of times get much better service from some of the smaller AMCs because it's local. It's more of a relationship.
Exactly. Yep.
And they don't necessarily need a national appraisal management company for all of their loans. They may need it for some loans if somebody's buying a second home in a different state or from where they live or whatever. But for most of the transactions, they can partner with a local appraisal management company that might be smaller, maybe have some more staff appraisers, and they can get those orders placed, in some cases better and faster than we can as a national company, because we're trying to cover a much broader territory and need. It's a different need. So control of the appraisal order is huge, especially now because the appraisal industry has definitely had some shortages,
Yes.
and supply and demand problems the last 12, 15, maybe even going on 18 months. So that's huge. Then the other piece of it that may be the biggest reason to consider going from broker to banker is control of the closing disclosure, when that goes out, and control of the closing package. And so as a broker, you have some control of the CD, and the closing package, but ultimately you're beholden to the closing department at your lender, the wholesale lender, in case of a broker. But once you become a correspondent, once you become a lender, mortgage banker, you're in control of the CD. A lot of times your investor can provide that service for you if you want. But most of our non-delegated correspondents or NDCs, they prepare the CD and they prepare the closing package, because ultimately that puts them in control of more in control of the closing. They're not going to be very likely to close the loan before it's been approved by an underwriter. But if the last thing they're waiting on is is the underwriter to sign off on the loan, they can have the CD prepared and out and signed and balanced with all parties. And they can even have the closing package out, just waiting on that underwriter approval. And it takes a lot of pressure off, and it puts them in control of those documents, where they're not waiting on another company to do those things. So yeah, I think, right, yeah, I think control of the CD and the closing package may be the biggest reason to consider, becoming a banker, because the more you control, to me, the more you can affect the outcome.
That's absolutely right. Yep. And and I think if you're working with a good law firm who can help you, especially in the outset, that you can really see, like you said, see what they're doing, watch how they're helping you control that, watching the timing of what they're doing, and if you want to, bringing that in-house and mirroring that yourself to maintain even more control, so that portion of it is not outsourced, but rather in-house and something you're doing. And like you said, then you really have the control versus even outsourcing that part.
Sure. Well, hey, what else? Anything that we missed? Anything that you wanted to cover in terms of the pros, cons process of going from a mortgage broker to a mortgage banker? All the things that emerging bankers or pre-emerging bankers might want to consider?
Yeah, I wanted to mention, the Fidelity bond and E&O coverage.
That's right. Thank you.
Yeah.
Thank you.
Yeah, and that although we are not, we're obviously not insurance underwriters or an insurance company, we do request that. And one thing that I think anyone listening and considering a move from broker to banker is going to want to do is, before of course, one of the check boxes that you're going to want to check is to check in with your agent and just make sure that the coverage that you have would cover you as a banker if you make that move, because I think a lot of people will get into being a broker and they'll have broker coverage for Fidelity Bond and E&O, and oftentimes is required by investors. But once you make the move to banker, it's actually a different policy. The wording that's in the policy might cover both, but you really want to check into that, because we did have a situation with a client who had been around for quite a while, had started as a broker, became a banker, and then he had a problem. He had I think it was a home that had burned down, and he had to go to his E&O coverage, and his agent had to tell him, hey, I know you've had this, but we haven't reviewed your policy in so long, and it's still a broker policy, not a banker policy, and you make this loan. So he had to eat that one. So
wow.
Yeah, that's one of those things that you just want to make sure on things like that, Fidelity Bond and E&O is sort of like, having car insurance, or, you're not going to use it all the time. Or hopefully you're not. If you are, you're doing something wrong, but, hopefully you're not going to use it very often. But if you do have to use it, just make sure you're covered adequately, and that your insurance agent that's helping you understands, the business that you're in. So if you're banking, make sure it's a banking policy.
So does the size of your Fidelity and E&O policy, is it relative to the, again, apologize for my ignorance here, do you think it's relative to the average loan size of what you're transacting in, or maybe the size of your warehouse line, or the size of your originations? I mean, like what's a typical claim, if there is a typical claim for one of those policies? Does it, obviously it probably has something to do with the loan size, because it's got some, or the size of the transaction, because there's some financial loss, but is a house fire a typical type claim? What are the kind of claims that you've seen?
Yeah, well, luckily we haven't seen any.
Right. I was scratching my brain too about. I can't recall.
I
can't recall anybody ever actually. The policies are required in most states to become a lender, but I don't ever recall anybody ever, other than paying the premium, ever using the policy. So that's interesting.
Yeah, well, they usually cover you per incident, and Fannie Freddie requires $300,000 per incident coverage. But $300,000, if you just think about a situation where, I don't want to pick on anybody, but so I'll just pick on Houston because this is where I'm at. We've had our fair share of natural disasters, and that includes floods. And
sure.
Let's just say you have a house that's sitting on your warehouse line, and the warehouse has advanced the funds to the closing table, and 3 days later Hurricane Harvey shows up, and the house that you financed for your borrower is in water over the front door. We're talking 12, 13, 14 feet of water in a house. And then let's say, and this is something that we actually look at, which is why I think we do such a good service for broker to banker transitions. We will actually collect and look at the insurance, the homeowner's insurance policy, and make sure that the insurance is effective and it's referencing the right property address. But let's say, the insurance deck page is what I'm referring to. Let's say the insurance deck page said that the policy had a policy effective date 4 days after the loan actually closed. And let's say that happened because the borrower told their insurance agent, this is our closing date. The insurance agent said, great, I'm going to get you your deck page out right now. That was what was in the system. That was the effective start date for the policy, but it happened 3 days, not 4 days. This flood happened 3 days after the close. Now you have a situation where you have a home that's underwater. And then let's say the home wasn't in a floodplain, so it didn't have flood insurance. It wasn't required. And the homeowner's insurance doesn't really cover that flood. It's not, we're talking about fires. We're not talking about and in some instances theft. We're not talking about flood. Then you have a situation where, hey, you've got a house that is going to need remediation and all kinds of other work on it, and
right.
You own the loan on that collateral, as we mentioned earlier. Well, you might have to hit your E&O policy for something like that, because that loan may be unsellable now. No investor may want it because the underlying collateral just became worthless from that flood, and it's not covered by insurance. So So yeah, that may be an instance where you might have to hit your E&O policy. Or we had a situation happen to us, which thankfully, because we looked at the insurance deck page, we knew that the homeowner's policy was good, but there was a situation where a home, it was a refinance. They were refinancing from construction to perm on a brand new home. It was a jumbo loan, and the house got hit by lightning while the people were at the closing table. Their brand new home and moved into it. The house got hit by lightning. It burned the garage down and fried the electrical system in the house. It caused, I want to say, it was like almost $100,000 worth of damage. Well, if that house was not covered by homeowners insurance, those people or that particular lender probably would have been hitting their E&O at some point to get the collateral repaired. So that's really what it's for, underinsured. But really, I think that would be, a lot of these things would be discussions for, between the agent and the lender, their insurance agent. But yeah, there's a lot of things to consider. I mean, those outside, outside events, the tail risk really is what we're talking about. Not things that are happening in the normal distribution, things on the other end of the normal distribution, several standard deviations away from the mean.
Man, think about that. So you're at the closing table signing all those documents, and while you're at the closing table, your new house gets hit by lightning.
Yeah.
And so then you go and you fix your electrical system or all the stuff you got to get fixed. And think about it, like the next thing that goes wrong in that house. I mean, that's going to be a high bar, for you to ever say that, hey, this is the perfect house. This house was meant for us, honey. And the minute that a closet door doesn't close properly, you're probably selling the thing and moving. I mean, it's like it's like if you even moved in at all, right? You might even not move in. I mean, what a sign. This is not the house for you. Holy cow. Holy cow. Well, hey, Brian, I know we ran a little bit long enough, but lots of great stuff, lots of great information in here. Obviously you've done this before. You've kind of mapped out a roadmap, for folks to use to at least consider all the risks, all the pros and cons of becoming a banker. But tell us a little bit more about you. So if folks want to learn more about you and Fidelity Bank, how can they get in touch with you? How can they find out, if this mortgage banker is the next best right step for them?
Yeah, no, they can find us on our website, www.fidelitybankmn.com. I and my counterpart, Susan Johnson, both have our own pages on the bank's website. You can learn more about both the emerging banker and the correspondent mortgage bankers that way. And then my contact information is on there, so they can give me a call at my office here in Houston, and happy to walk through and revisit any of these topics. And I'll just close out by saying, hey, when you're working with a warehouse provider, you want to find one that's with experience and a long track record, where you're going to get attention as you move through the broker to banker transition, and someone who can grow with you as you grow through those cycles in life and be that trusted advisor that you need to help you as you move from broker to banker, and as you move from non-delegated to delegated, and then eventually from delegated doing bulk delivery, having a centralized lock desk, hedging, connecting you with resources for, trade lines, hedge advisory, that kind of thing. We've done it from, line sizes. Like I said, we start out 2 million all the way up to 100 million. Have done it since 1986. Of course, I was in high school in 1986. So that's,
that's a long time ago.
That's right. That's a long time ago. So yeah, if you're going to work with a warehouse lender, work with someone who has got a lot of experience and experience in all phases of the growth cycle for a mortgage company, and that can be there for you.
Well, that's awesome. Well, hey, Brian, I really appreciate your time. Thanks again for being a part of Renovation Radio.
Hey, Mark, thank you so much for having me on. Really appreciate it. And happy holidays to you and everyone listening.
Talk to you soon. Thanks, Brian.
Take care, Mark.